Welcome everybody to today's Worth and Wealth webinar. Today we'll be talking about planning for retirement. My name is Carrie Palazzo and I work with the State Treasurer's Office of Economic Empowerment. I'm also joined by my colleague, Jennifer Duran, who will be supporting any questions in the chat. Additionally, after today's presentation, Jennifer will share by email resources, a recording of today's webinar, and the slides as well. So please look forward to that. Okay, again, today we are talking about planning for retirement. Today we are joined by Samanda Morales. She is a financial advisor and investment manager and affiliated with the Financial Planning Association of New England. Samanda is an investment manager, financial advisor, and founder of Wealthfin 360, where she provides personalized financial planning and investment services to professionals, first-generation wealth builders, and business owners. With over 20 years in the financial services industry, including leadership roles at Bank of New York Mellon and State Street, she simplifies complex financial challenges to empower her clients. As a passionate advocate for financial literacy, she co-founded Ahora Incorporated, a nonprofit supporting low-income individuals, and serves in leadership roles at Salem State University, North Shore Chamber of Commerce, and other reputable organizations. Samanda lives in Massachusetts with her family and their golden retriever, Bella. Samanda, thank you so much for being here. The show is yours.
Thank you. Good afternoon, everyone. I hope everyone's doing well. I'm going to share my screen. Okay, good afternoon again, everyone, and welcome to the Worth and Wealth Seminar, Retirement Planning. And as Carrie mentioned, my name is Samanda Morales, and I'm an investment manager and financial advisor, and I am delighted to be with you this afternoon to talk about retirement planning. And as I said in a few seconds ago, if you have any comments or any questions throughout the presentation, please put them in the chat, and Jennifer will let me know if you have anything that you would like to address during the presentation. If during the course of the presentation you do have a question or need a resource that we do not have at the moment, we will definitely follow up and provide any kind of information and resources that you do need after the presentation. So I wanted to ask a question to everyone that's on the call. What does retirement mean to you? When you think of the word retirement, what does it mean to you? What comes to your mind? So I'll start with mine. What comes to mind is not waking up early and driving into work.
I see no work. I'm no longer working at my current position are some of the responses here. Flexibility, that's a good one. Probably for work and location.
Awesome. Well, thank you for offering your comments. And I think this is something that everyone can relate to, whether you're 18 years old or whether you're over 60. So for today's agenda, there are some key items that I want to make sure that we walk away with. And one is the importance of retirement planning. How much do you need to retire? What's the retirement process look like? And what are the retirement income resources that you should be thinking about? What are the retirement income resources that are available to you as a working individual? And what are the steps to prepare your retirement plan? So those are the key points that we will go over during today's presentation. So why retirement planning matters? One, retirement planning is a journey. It's not just a single destination. Retirement planning takes consistency, and the earlier you start, the better. It really matters because people are living longer nowadays. Healthcare costs can be significant expense during retirement, specifically as we age. And we definitely want to avoid running out of funds during our retirement years. And having enough to fund for post-retirement living expenses like food, housing, transportation is really important. So we don't find ourselves in a position where we're now retired and we don't have enough funds to fund the really basic needs for food and housing, etc. So what are the phases of retirement? And as I go through the presentation, I want to make sure that I break it down in between pre-retirement, during retirement, and then how do you address if you think that you have a gap in your retirement plan? So the first line right here is retirement age. And as you can see, there's no age identified here because retirement age can be specific to everyone. Some people may decide to retire at 67, 65, or even delay retirement at 70. So each one of us needs to find out, okay, when do I actually want to retire, or when can I retire? And then once you determine that retirement age, then you can plan accordingly. So once you find out what the retirement age is, then, okay, during my accumulation phase, so between your working age of, let's say, 25 to that retirement age, what do you need to do? Think about how much you need to save every month. What kind of investments do you have available through your employer, or if you have an individual retirement account? We'll go over that in a little bit. What are the various retirement income sources that are available to me that I can start seeding now, where I can have access to it after retirement? What are the types of accounts? What are my contribution strategies? Do I contribute pre-tax? Do I contribute after tax? And then the investment strategy comes to, do I want to invest more aggressively because I have 20 years of accumulation phase? Or if you only have 10 years, like, what's your investment strategy going to be? You definitely want to be less aggressive on your investment strategy the closer you are to your retirement age. So those are some of the information and questions that you want to have in the back of your mind as you think about retirement and as you are planning toward retirement. And then after you retire, then after retirement age, then what happens? Then the distribution phase comes into play, where how are you going to decide to receive your retirement payments? Is it a lump sum? Is it a monthly payment, or do you receive on a quarterly payment basis? From which retirement source will you receive the income payment? So let's assume that you have Social Security and that you have a 401k through your employer. And then if you have HSA, so those are 3 income sources. So then for your medical expenses, you have access to the HSA. You should tap into your Social Security payments as an income resource. And then you have your 401k payments as an option as well. So deciding from where and how you're going to receive those payments, it's also something that you should be planning for during the redistribution phase. What sequence do you receive those income sources? How do you need to adjust your investment strategy now that you are retired? And you would definitely want to maintain the capital that you have saved so far. So your investment strategy is going to change from a more aggressive to more or less aggressive strategy, so you don't lose the capital that you have accumulated during the accumulation phase. Any questions, comments, or any experiences that you want to share from an accumulation phase, or those that are nearing retirement? Any bad experiences that you've heard from people that you know? I have to say, for example, I know, well, I used to work at BNY Mellon, and I met this person that worked for 30 years, and the person didn't have a retirement account. He thought that Social Security, he was relying on Social Security, but the company that he worked for offered retirement planning and retirement accounts, but he didn't take advantage of saving during those 30 years. So after 30 years, he realized, whoa, I should have been investing all this time.
We have nothing in the chat so far, but if anything trickles in, I'll let you know. Thank you.
Thank you. And then another thing that I want to point out is what's called drawdown strategy. And let's say you have, I'm going to simplify the numbers. Let's say you have $500,000 toward your retirement. Deciding how much to take out of your retirement account, either by a percentage. I'm going to take out 4% of my income on an annual basis from the $500,000. Or you can do it on a fixed dollar amount. If you know that you need $3,000 a month for your living expenses, then you can draw down $3,000 from your retirement fund each month by $3,000. So it's based on a percentage or on a fixed dollar amount that you take out every month. So let's walk through a scenario of the importance of starting early. And I've done financial workshops at schools. I did one in a high school and another one at for a middle school. And the one in high school, the senior in high school, we talked about at college, we talked about life after higher ed. And the person, they wanted to go to get a job, but retirement planning was not something in the back of their mind. It's not something that young people really think about. It's not something that I thought about when I started working. But now that I'm older, looking back and realize that starting early really makes a difference. So I want to walk through a scenario of what it looks like when you start early versus when you start a little bit later in life. It's never too late, but the earlier you start, the easier it will be to start saving toward those retirement years. So we have two people. We have George and Maria. They're both age 20. So George started working at 20. He didn't have any contribution toward retirement from 20 to 30 years. Then we have Maria, on the other hand. She started working at 20. And for the next 10 years, she contributed $2,500 a year toward a retirement account. George, he continued to contribute. He started to contribute at age 30. He contributed $2,500 a year. And when he was 65, he had a total investment of $87,500. So now we have Marie, on the other hand. She stopped contributing. And her investment grew to a point where she had $536,000 at the end of when she was 65, versus George, $430,000 at age 65. So I'm going to leave the screen for a few seconds here so we can see the difference. So George didn't start contributing until age 30. George didn't think that at age 20, it was still too early or too young to start contributing toward a retirement account. Versus Maria, I'm going to start investing. I'm going to start saving at 20. And then she stopped at 30. And she still had a higher balance at the end of when she was 65. So why is this? Money and time are best friends. So the longer you have
Okay, apologies, folks. I think Amanda froze there for a bit. We'll give her 1 second.
Okay. So Jennifer, I'm not sure when I lost the connection.
Yes,
Did,
so it was right after kind of just making the comparison that even though Maria stopped, she still had an advance against George, if I remember
okay,
correctly.
thank you. Thank you,
Mhm.
Jennifer. I apologize.
Of course.
So yeah, so even though Maria started at 20, then she stopped at 30, the time that she was invested from 20 to 65, the investment compounded to a point at 8% on average on an annual basis. That gave her a balance of $536,000 at the end of 65. So the more you have your dollars invested in the market or in an investment account, the higher your interests are going to compound because your principal is going to increase, and therefore you will receive more of a return based on that increased capital versus George that started 10 years later. So if this is again a really good reason why to start early. And the next slide, I want to show another important factor of starting early. So when someone starts at age 20 to contribute to a retirement account, in this scenario, we just assume, let's say this person wants to have $1 million by the time he or she retires. If you start saving at 20, you only need to save $361 a month. Versus someone that starts at age 40, for example, will need to contribute $1,400 a month to be able to achieve $1 million by retirement. And then as you can see, the later you start, the more you're going to have to set aside to make sure that you have the retirement fund that you're seeking. And of course, there are different circumstances and scenario where you cannot save that much money, but just to give a comparison that if you start earlier, you can start contributing a lower amount versus starting at 40 or 45. You will have to contribute a higher amount on a monthly basis to reach that retirement goal of $1 million in your retirement account.
And also we have just a few quick questions here in the chat. One of them being, would it make sense to move retirement savings to a high yield savings account while you're in retirement?
It depends. If you are 65, for example, and you need your dollars to last to your 90 years old, that is going to be a 25-year stretch. In a high yield savings account, you're not going to receive the return that you need to make sure that your dollars last until you're 95, or if you're older by the time it's called end of life. So I will say that, and I'll go over in a little bit of the presentation, break down your sources in 3 different sections. The first one will be more of an immediate need. Then yes, you can move that fund into a high yield savings account. For example, if you know that you need $10,000 by in 12 months, then take out the $10,000 from your retirement account and put it in a high yield savings account. And that way you have access to it right away. But I will not recommend taking the entire balance and putting in a savings account because you still need growth during the retirement years. However, just going to be a less conservative, a less aggressive investment, but still you want to achieve at least 6% or 7% of return in the market.
Thank you. That makes a lot of sense. And we have one more. This is more of a policy question, so it's okay if we can tackle it at the end. But it's, what is the status of the windfall provision for Social Security in Massachusetts? Are you familiar with that by any chance?
Not sure, but we can definitely provide that after.
Yes. And also we have a follow-up email where, anything not covered, we can provide resources there. But thank you for the question. That was really good.
Yes,
And that's it from my end. Yes.
Thank you, Jennifer. Thank you for the questions. So yeah, again, it's never too late to begin saving. So I don't want anyone to be discouraged that I should have started earlier. It's never too late. It just means that as the longer we delay the planning, the more consistent and aggressive we need to be to plan. We need to be and plan for retirement. So what's the retirement planning process? So I suggest that you start at least 1 to 2 years before you plan to retire. So once you have determined the age in which you want to retire, then work yourself to that 1 year to 2 years before retirement age. And again, as I said at the beginning, retirement, it's not a destination, it's a journey. So we need to start that process earlier to make sure that we have all of the things that we need and the funds and the peace of mind during retirement. So the first step I will say is for you to go through what's your current financial situation? What's your current monthly income? What are your monthly expenses? What are the current accounts that you have access to? And I know some individuals, especially if you work for an employer where you have access to a couple of retirement accounts, like a 457 or a 403 or 401k, like try to have an inventory of what are the retirement accounts that you have invested in the past, previous employer or currently. So you want to have an inventory, what you have available. And then how much are you currently saving, but how much you start saving if you need to increase going forward. As your income increases in your career or your professional phase, maybe just increase your savings rate, meaning how much money are you putting away on a monthly basis compared to your income. You should increase it as you receive wage increases or increase in income. And then the number 2 is define your retirement goals. The age where you want to retire and how do you envision your lifestyle. And these are one of the things that I talk to with my clients, like how do you envision your life looking like after retirement? Do you want to live close to the beach, or do you want to make sure your house is paid off, or do you want to live close to your family members? Like, plan, how do you envision your lifestyle? Do you want to travel once a year, or do you want to travel cruise during a retirement? So once you picture what your life is after retirement, then you can set those goals and adjust your plan accordingly. Then estimate what your retirement expenses are going to be. And I'll go over a table where you can have a good indication of what that is going to look like after retirement. But just know that your current expenses will change after retirement. When you stop working, you don't need to worry about transportation getting to work or clothing for work, or there's you don't need to buy lunch at work on a daily basis because you're not going to incur those expenses after retirement. So what's your discretionary spending going to look like? Maybe your travel is going to increase. Maybe you'll pick up a hobby or you'll want to go to concerts or the movie more often. So those will also change. And also assume that the inflation is going to increase between 2 to 3% on an annual basis. So that should also be worked in your financial planning to a retirement calculation. And I do want to point out that retirement planning involves sometimes complex decisions with many options, and financial planners use various financial planning softwares that can help individuals plan for those what ifs. So what if the inflation goes up 3%? How much do I need to have in my retirement account to last 25 to 30 years during retirement? And you can seek a professional guidance if you feel like you need that support. So again, one, assess your current financial situation, your income, expenses, retirement accounts that are available to you, and how much are you saving. If you do have a 401k through your employer, how much is your employer matching? Is your employer matching contributions? If your employer is matching contributions, make sure that you take advantage of that matching contribution amounts. Define your retirement goals. Where do you want to live? When do you want to retire? How do you want to live? And then estimate those retirement expenses, because it will impact your retirement planning. And then number 4, evaluate those income sources that we talked about in a few seconds ago. Estimate your Social Security benefit. You can go to ssa.gov, and they have a calculator up that you have access to, where you can enter your estimated income, your age, and your age that you're planning to retire, and then you can have a monthly estimated amount where you will receive Social Security benefits. If you have any pension plans, if you have a pension plan through the state, for example, or the municipal employer, what are the requirements for the pension? So if, for example, if you're a state employee, if you're in group A, what does that mean? If you're group B, what does that mean to you? How much will you get if you retire by a certain age? And then also evaluate if you have any personal savings or high yield savings account, for example, as someone brought up earlier. And what are the investments that you have available? 401k, IRAs, which is individual retirement accounts, and Roth IRAs. And I'll go over in a little bit what's the difference between an IRA and a Roth IRA. And then annuities are basically contracts where you are guaranteed a monthly income. You can purchase annuities as a income to supplement an income if you need to after retirement. Then build a retirement savings plan. Maximize your contributions, especially for those that are tax advantage accounts like the 401k, an IRA, or the Roth. The Roth is after taxes, but the 401k, you defer taxes until retirement. Take advantage of employer matching contributions, as I just mentioned earlier. Diversify your investment portfolio. And I know that a lot of individuals are really, I don't want to use the word afraid, but hesitant to invest in an investment that's aggressive. But think about this. You have the next 20 to 30 years to weather any ups and downs in the market. So you definitely don't want to be too conservative at the beginning of your years, because then the return that you will get on a yearly basis may not be sufficient for you to have the enough funds that you need during retirement. So as you are in the beginning of your early career, you can be more aggressive. And as you near retirement, the investment strategy can be more from growth to stable. And then consider automating those savings to ensure consistency. Sometimes clients may save for 20 years and not even think about how much is being saved. And by the time you go back and look at the balance that you have there, you'll realize that you've done much better than what you thought. And then healthcare cost definitely increases as we get older. So plan for those increased healthcare costs. Research medical and supplementary insurance options. And we'll go over a little bit the Medicare options that are available for retirees. And then plan for those long-term care costs. Increase visits to the doctors or prescription and things like that. And then build that emergency healthcare fund in case you do need to pay for out-of-pocket expenses that you do not account for. So having those multiple sources of income is definitely helpful.
So I do have one quick question. Are there, just based on the chat, are there any resources or what are your thoughts for those who maybe have already retired, who may need additional funds for things like healthcare costs if they didn't have the opportunity to maybe do that 1 to 2 years of planning before retirement?
And I'll go over it a little bit later in the presentation. If there are different options within the Medicare system that you can have access to or have a supplemental insurance option. So even if you are during retirement, you can have access to those options and those supplemental insurance options where you can purchase enough to supplement that extra cost that you're incurring now.
Okay, thank you. And we can also send up follow-up resources for that question. So thank you, Gloria. And just one more question from Edward. You mentioned longer life expectancies. So what would be a good age range to plan for when thinking about, end of life expectancies? Is it 90, 95?
Great question. So I will say 95. And when I go through financial planning with my clients, I plan to 95. If you have a history where your family lives longer, then plan for a little bit longer, but at least 95. And you can reassess your plan as you get closer to that age. And then if you need to adjust it, you can adjust it accordingly. But I will say 95.
Okay, awesome. Thank you. And I think that's all the questions for now.
Thank you so much for the question. I love the interaction, so please keep them coming. So where can you save? So as I mentioned earlier, your employer will provide access to a retirement account, hopefully. If you have an employer that does not offer a retirement account, you can have a conversation with them, but then there are other options where you can save for your own retirement, and I'll go over those shortly. So there are 3 major plans. There are 403B, usually nonprofits provide 403B, 457 for state employees, municipal employees, and then you have 401k for private employers, where you have 2 options. You have the option to contribute toward those plans pre-tax, meaning before you pay taxes on your income, or Roth, it's after tax. And you can contribute up to $20,500. So the Roth option, and this is actually one of the things that I recommend to my younger clients that are just starting working, that you can contribute toward a Roth option because it grows tax-free on earnings that you put in the account. You don't have to pay taxes when you take them out. And as you start your career, the assumption is that your income is lower, so the taxes that you will pay then are much lower than you will pay as your income increases. Pre-tax, you put it before you pay taxes, but then when you retire and you start taking those funds out, you pay taxes at the tax bracket during your retirement years. And then ensure that you put an amount where your company is going to match. For example, you may have a company that will match up to 4% of your contribution. So you want to make sure that you contribute 4%, so your company matches 100% of your 4% contribution. So that's basically money the company's giving you toward your retirement. So if you're not sure if your company matches any of your contributions, make sure that you talk to your HR representative or go to the online resources that your company or your employer may have. If you're over 50, you have what's called a catch-up rule, where you can save an extra $65 a year and put that toward your retirement account. Then you have HSA for those high deductible insurance plan. And the combined for your contribution and the company contribution is $3,650 for individuals, and then $7,300 for a family. So an HSA account is a really good option if you do have access to one, because earnings that grow in that fund are not taxed if you use it for healthcare cost. So if you need it for any hospital visits or doctor's visits, you don't pay taxes on any of those earnings where you accumulate it in the account. And the HSA is also has an option that if you don't use it in a particular year, you don't lose those funds, they just roll over to the next year. And then you also have the option, if you're over 55, you can contribute an extra $1,000 to the account. And then we have, if you don't have access to an employer sponsor retirement account, you can open your own traditional IRA or your Roth IRA. Or then now you have employers that also provides IRAs. And I've seen individuals have a 401k and an IRA in addition to the 401k, just to have multiple sources during retirement. So again, the traditional IRA is pre-tax. You put in money aside in a retirement account that is not taxed yet. You will pay taxes when you start redeeming the funds, and you have till 59 and a half to redeem your funds without any kind of penalties. If you do take your money out before 59 and a half, you will pay a 10% penalty plus the taxes. The Roth IRA, again, grows, it goes after tax, so you don't pay taxes when you take them during retirement after 59 and a half. So the contribution amount for anyone younger than 50, it's that $7,000 a year. And then if you're over 50, you can set aside an extra $1,000 as a catch-up contribution. And then you have your taxable savings, like a savings account, a CD, a cash deposit account, or what's called a taxable brokerage, where you can invest in non-retirement accounts like mutual funds and bonds and other types of investments that grows that are taxable. So when you pay for taxes on any of the growth that the investment is providing on interest, dividends, or any revenue that you're generating from your investment. Any questions, comments there?
Yes, we just have one question. Someone mentioned that if they reach the age where they must withdraw money from their pension, if their retirement account, their former retirement account, if you would suggest putting that money in a savings, or what would you suggest doing with it if they don't need it, let's say, immediately?
Great question. The high yield savings account is a good option. Or you can do a CD if you want, if you don't need the funds within 12 months or a year, it can be more longer term. You can do a CD or that high yield savings account while the interest is, I think is now 4.5%. So I will put it in those two. If also you could put it in what's called a money market account, where you're receiving interest, but it's not as aggressive, where you may lose some of that capital. And I'll go over in a little bit. There's a slide that shows the options of what where you can deposit that money on a short term. Jennifer, anything else before I move on?
No, that's it. Thank you.
Okay, thank you. Yeah, and I'll go over that slide of those different options where you can put a short term, midterm, and long term. Great question. So, and this slide shows different possible sources of income in retirement. And again, the more resources you have available during retirement, the better. It's like having your eggs in different baskets, not all in one basket. So definitely the three biggest one will be your 403b, 457, or 401k. Those are employer sponsored retirement account. And then you have your pension plan if you work for the state or the municipal employer. And then you have your Social Security, and then any personal savings that you will have available to you, the savings account or a brokerage account. So you want to break your sources in these 4 different ways. The way to break down how much do you need after retirement? A good range will be, okay, I need to supplement my income after retirement, 60% of my income or 80%, 85% of your household income. And that's going to depend a lot in that financial inventory that I went over a few slides ago. What's your monthly income? What are your monthly expenses? How are your expenses going to be after retirement? Are you going to be traveling? Are you going to pick up a hobby? So once you have all the information, then you can determine, okay, I think I need more of 85% of my income after retirement, not 60%. So having those numbers to begin with will definitely help to find out how much you should be saving and how much you're going to need after retirement. It is recommended you at least save 10% to 25% of your pay if possible. I know that it's sometimes, especially for people that have a limited income, it's not something easy to do. But going through that financial inventory and a budget will definitely give you a better understanding and sense of how much you can possibly set aside. And then work in your average annual return. As I said in a few slides earlier, average return will be between 6 to 8% in the market. So you can work that in as you do your calculation for your retirement funds. And then how much do you need? And this is one of the sources that I'll definitely share at the end. You'll receive a resource after the presentation. Bankrate.com has a retirement plan calculator where you can enter how much you have saved, how old are you now, when do you plan to retire, and then it can give you an indication of how much you need to have saved by the time you want to retire. But we'll share that with you after the presentation. But it's bankrate.com. So I want to go over an example of what a budget would look like pre-retirement. So on a piece of paper, or I'll share a couple of resources of apps or tools that you can use to keep track of what are your expenses today. And again, this visualization and homework will help you determine how much you need to save today to make sure that you have all of your needs covered while you are retired. I've come across a lot of people that thought that had enough money to retire, but then didn't have enough. And I think one of the questions was earlier, like, what do I do if I don't have enough? Either have to pick up a part-time job or buy an annuity to supplement that income. So doing this homework now, or while you're even if you're in retirement now, you can still put this information down on a piece of paper and see where your expenses are actually going. So the first one is housing. So let's go through this example. Housing, $1,800 a month, between food, $575. Let's say your healthcare insurance is $490, and this is monthly. You have disability insurance and long-term care of $200. So let's say all of this adds up to $6,670. These are your monthly expenses. And you're saving $700 for retirement, or if you're going to school or an emergency fund. So that is $700. So this will be an annual income of $80,040. So if you go through this budget and you write down all of your expenses, so this is how you're going to determine how much do you need today. And then for retirement, you can have a retirement column. Okay, now you know that your hopefully your utilities will go down. Your the groceries will go up because now you're home a little longer. Your transportation will go down because now you may not have a car, or you may not need public transportation. Your insurance will increase because now as you get older, you may need to either have more doctor visits or healthcare prescriptions. Your travels will go up. Your insurance, disability or long-term insurance will go up. So as you can see, some expenses increase, some expenses decrease. So in this particular example, the expense for this person will be now $5,670 after retirement. So you don't need to plan for $80,000 a year. Now you need to plan to have $68,000 of annual income during retirement. Does this make sense? Any questions here, or any comments, reactions?
Just one comment here is, how often should I review or possibly revise my financial plan? And I guess it's a 2-in-1. What annual rate of inflation would you assume for long-term budgeting in regards to retirement planning?
Great question. Great question. So budgeting, I will look at your expenses on a monthly basis to ensure that if you're accounting for example, $575 of food, that's consistent on a month-to-month basis. Then more of a, how much do I have in my retirement account, and what are the sources that are available? I will say at least once a year. Just to make sure that things are on track, and just to make sure that you're accounting for the right amount of inflation, and for the anything also that comes up during the year. So now if you have financial goals that you need to account for, then you want to make sure that you include that in your updated financial plan. So again, month to month, your expenses, how much, where you're spending and how much you're spending, and then at least once a year, review your retirement accounts and other sources of income, other sources of retirement funds that you have. Great question. And then for the inflation, I always like to be more of a safe side. So I will account for a 3% inflation rate, just to be on the safe side.
Okay, thank you. And then Erica just made a comment that said this is a great illustration, so that's nice. Thank you.
Awesome. I'm so glad it's helpful. Thank you so much for the questions and the comments. Okay, and here are the suggested tools. So if piece of paper is one option, and then there are budgeting tools. Mint is no longer available, as I'm sure you know. So I put down this app Ramsey Solutions has. They have a free basic version. It's called Every Dollar, where you customize your budget and you can keep track of your expenses. And they also provide financial education. Then if you want to, they also have an option where you can have the premium subscription, and they have what's called the debt snowball tool. If you have a lot of debt that you want to pay down before retirement, you can use that debt snowball tools to basically pay down any debt from smallest to largest. So that's one of them. The other one is Albert, that I have personally not used, but you can create a budget. It can track your spending habits. You can see how much you're spending going out to eat versus groceries. You can keep track of your bills, which is a good resource, so you don't forget to pay bills. And you can also keep track of your income. And then upgrade features will allow you to have access to an actual person that can provide personalized advice. I'm not sure how much the upgrade is, but you can check the website, albert.com. And then the last one is you need a budget. You can import transactions from your bank account so you don't have to enter them manually. Or if you are one of those that myself like doesn't like to link your bank account to a budget app, you can import those monthly and then you can review them on a monthly basis. And you can develop what's called an envelope-based system to keep track of your spending. So you can allocate, okay, I'm just going to spend X amount of dollars when I go out to eat. And then you can set that amount of money in an envelope, and then the app is going to let you know if you're close to spending that amount or if you're on track. And that one is $84 a year. And then the last one, if you're not an app person, you can use worksheets. And there are 2 links available here in front of you, but we can share those with you after the presentation, where you can go in and use their Google Sheets to update the worksheet, and then you can keep track of that on a worksheet. So again, remember to go in at least on a monthly basis to update those expenses, ensure that you're on track. So compare them month to month, and then you can see if you overspent on a particular category or if you're on track on all of your expenses.
Samanda, hi there.
Yes.
It's Carrie. Hi, everybody. I just wanted to check in. It is 12:55. However, I think we're sharing some great information, so please feel free to keep sharing. And I would just remind everybody on the call today that there will be a recording of the webinar as well. So I just wanted to check in on time, but we will be able to share the recording if you have a commitment at 1. And if we go over, because again, there's such great information to share, that is okay. That recording is coming.
Thank you so much. Thanks for the reminder. Okay, a simple model of what it would look like for various sources. So this is the first section is your pre-retirement earnings. And let's assume that your earnings are increasing on a yearly basis. And then you retired. You have 70% to 85% of your pre-retirement expenses. And then you're assuming that you're supplementing 80% of your income during retirement. So what are the different resources? And this is what is the whole picture, based on all the expenses that you have on a monthly basis, what are the resources available to you, the income sources available after retirement, and how are you going to deploy those funds during retirement? So the first one will be your Social Security benefits. It will be the first set of funds. And then the next one will be what's called a profit sharing, but it's basically a 401k or a plan that your employer provides, where they're giving you opportunity to share in the profit of the company. And then your 401k dollars, and then your HSA for those medical expenses. And then at the end, it will be those personal assets if you need them. So again, these are how your income sources will be broken down as you pay your monthly expenses after retirement. Social Security, what's called profit sharing or retirement plans, your 401k, HSA for medical expenses, and then your personal assets like your savings account, CDs, and taxable account, brokerage accounts. If you find out, oh my goodness, I'm short, what do I do? options that are available to you. So definitely make sure that you come back next month for that. Reduce your discretionary spending if you are able to. Delay your retirement age. The longer you delay your retirement age, the more your Social Security benefits will increase. Postponing age or benefits increase 8% on an annual basis up to age 70. And I'll give you a table where you can see that, and I'll demonstrate that in a little bit. And then you can have post-retirement work, a part-time or flexible time working online or doing other work where you can supplement your income. So this is where I said earlier that you can segment your funding sources and based on your time horizon. So for those that ask, okay, what do I do if I don't need the money immediately that I am receiving during retirement, or where can I invest my funds on a short-term basis? These are the options. So you can have it in a bank account, savings account, a cash deposit, or a CD, what's called a money market, where you receive an interest for investing in a very conservative short-term vehicle, or you can invest in what's called short-term bonds. Again, make sure you come back next month because the FPA is going to go over investing. So these are safe vehicles that you can invest short-term, and short-term meaning you need in less than a year or 2 years. And then you have medium-term instruments. It's combined with dividend-paying stocks, so stocks that don't move a lot in prices, but rather where the prices stay stable, but they pay dividends, like utility stocks pay dividends. So that is one where you can invest and you receive dividend, and then the prices don't fluctuate a lot. And then bonds are just interest-paying instruments. And then longer term, it's more of aggressive, where you invest in what's called large, medium, and small cap stocks, basically large companies, small companies, or international stocks, what's called real estate trust and commodities. But again, we're not going to go over into those instruments today. That will be discussed during the investing class. Questions before I move on? I know I'm going a little bit fast, so I don't want to take up too much time, but any questions or comments on this screen?
No questions so far.
Okay. So I want to really touch base about Social Security because it's important to know this. So once you find out when you're going to retire, know that full retirement age based on security benefits purposes, it's 67. So that's when you're going to receive 100% of your benefit. If you retire earlier than 67, your benefits will be reduced by 20 to 30%. So it's important to know that. So if you retire at 62, you're not going to receive the full benefit of Social Security. If you delayed your retirement, then your benefits increase 20 to 32%. So if you're able to delay retiring after 67, know that your benefits will increase accordingly. And this is a little kind of hypothetical monthly benefit by age. And you can see at 66, if you retire with a $1,500 a month, if you delay that to 69, for example, you will receive an extra $360 a month. So this, if you retire earlier, let's say you want to retire at 62, you will only receive $1,100 a month. So understand what it means to retire early and what it means to retire later. And you can visit ssa.gov so you can find out more of your personalized numbers based on your history. Again, if you claim early, you have that option, but know that your there's other things that if you need money, your cash flow earlier, of course, that's an option that you have. You are available to those funds. Or if you anticipate a shorter life expectancy, so if you have a family history or something's going on in your life where you say, I don't want to wait till I'm 70. Later, you can delay it if you don't need the cash flow at 62 or before 67. If you anticipate living a long, 95 to 100 years old, you can delay it. And that way you can maximize those benefits after.
We do have one quick question. That is, do you receive Social Security if you move out of the country after retirement?
Yes, yes. I think, and you definitely then want to make sure that you have the some kind of like a bank account or an address here, or some kind of that at least the system knows where that you worked here, and then there's a bank account available to deposit the funds.
Okay, that is it. Thank you.
There are other sources that Social Security benefit payments. So if you have a spouse, if you're a survivor, or if you have disability, so those are other benefits that the Social Security you can receive from the Social Security benefit payments. And again, you can visit the ssa.gov website for more information and more detailed information that is specific to your situation. I do want to point out here that if you work for the state of Massachusetts in a pension plan, that you do not pay into retirement. So just know that that if you are a teacher or if you're in a pension plan in the state, you will not receive Social Security, but rather receive a robust pension payment from the plan, the state plan. You do have minimum distribution requirements, especially if you have pre-retirement account. You need to start making those minimum retirement distributions by 7.5. If you don't, then you'll be assessed taxes by the IRS. So make sure that you find out when you retire, and then if you're prolonging your retirement, that you need to start making minimum retirement distributions if you were born after 1949 by age 72. If you were born before July 1949 by age 7.5. So is this saving for healthcare? We talked about HSA, so I'm not gonna go over that. Again, this is for Medicare. You do have options. Part A covers hospital, Part B medical, and then you have supplemental plans like middle gap plans. And I think someone asked earlier, what if I have a gap in my insurance? So you can have the supplemental plan to supplement any benefits that are not covered by the original Medicare Part A or Part B. And then Part D is the optional add-on to cover any Medicare subscriptions. So then what happens, make sure before you have in place what's called a contract of law. If you have any retirement accounts, that you have something in place, that if something happens to you, you know where your funds are going. Either transfer on death or transfer paid on death. And you can talk to a state planning lawyer for that. But we can provide more information about this if someone really wants to receive more directed information. But the bottom line is that you want to make sure that any funds that you have accumulated in your retirement account or your personal account, or any real estate that you own, that you have something in place to documented for the state to know where those retirement accounts and your real estate is going if something were to happen to you. So there's a different ways of making sure that you have that in place. Make sure you have designated beneficiary in your retirement account. And then long-term care is 3 options: do it yourself, out of pocket, which is really expensive. And then you have insurance, long-term care insurance, and Medicaid. So those are 3 options to pay during retirement. So that's the last slide I had. Any final questions or comments? If not, then Carrie, I'll hand it back to you. Thank you, everyone, for your attention and your time.
Thank you.
Thank you so much. Really great information, really helpful. As part of the Worth and Wealth program, we offer these webinars. Additionally, you are eligible to participate in free financial coaching with Oriana Felkowski, who is a certified financial coach. There's a QR code there to register. We will also put that in our follow-up email. It's a really great opportunity and hope people can participate. Okay, our next webinar is in December, which I cannot believe is going to be here soon. It is developing wealth building habits. And that is going to be on December 4th. There is a QR code there to register. Additionally, that will also be in the follow-up email. As a resident of Massachusetts, you have access to free financial digital education on Enrich. It has videos, webinars, some budgeting tools, calculators. So please jump on there, sign up, share with people in your family and in your networks. Thank you for joining us. Thank you, Samanda. I really appreciated this topic and your time today. Jennifer, thank you so much for being in the chat and getting questions answered. Thank you, everybody. Have a great day.